wanted to talk about international markets. It's an area that's been intensely debated at our firm, and it's an area that we think that there's a lot of opportunities. With the recent changes that we've made to the portfolio, we've actually added to international, both on the developed side by adding in a little bit more exposure to European markets, and then in the emerging market space, adding in a fund that actually strips out state-owned enterprises. So companies that are owned by the Chinese government, the Russian government, for example, those are stripped out of the portfolio. So just adding a little bit more diversification. So why do we like international? Why have we been debating it? It's an area that, from an economic standpoint, has been growing. And last year we entered in the first year, and I'll go through some of these charts, where every major economy was in a growth phase. So you can see over the last 17 years or so, it becomes very cyclical. And where we're at today and where we're seeing growth for the next several years is we see this expansionary phase that international economies are in, not just the US. The US has been the dominant economy over the last, let's call it 5 to 10 years. And international economies have been lagging. Well, now we're getting into a phase where those are going to start to help as well. And we think that's going to be a positive for equities. So the fact that we're entering into this growth phase that may be multiple years ahead of us, we think is a positive. Now, when we look at international equities, what's another factor beyond economic reasons? Well, you could look at valuations, and we'll look at it a couple of different ways. But this blue line here looks at the MSCI EAFE Total Return Index. So it's a broad measure of international stocks, developed international, like Western Europe, Japan, et cetera. And you can see, going back to 1970, that orangish yellow line gives you the trend. On average, it's grown at about a 6.4% annual trend line. Well, right now, today, we're about 30% off of that trend. So from a valuation standpoint, it's a pretty compelling argument to invest because, as you can see over time, it reverts to the mean. And the mean right now is about 6.4%. So 30% off, we think that there's room for those markets to run. So now when we look at valuations on a comparative level, yes, those markets have grown. I think anybody would sign up for a 127% return. But when you compare it to the US market growing at nearly 300%, it's a big difference. And it's created a fairly large gap in valuations. If we look at we've talked about price to earnings, but price to earnings on international stocks versus where the S&P was at the end of the year, there's a stark difference here. And what the lines show you, the gray and the purple, over time, international stocks may outperform, the valuation gap narrows, and then over time, the S&P 500 or US stocks outperform, and that valuation gap widens. So we see a cyclical trend. I know we talked a little bit about it last year at this event, but we think that we're in the start here of a multi-year phase for international equities. So we want to make sure we're exposed, we want to make sure we're diversified, and we're adding to it little by little within the portfolio because we do believe that it'll be additive from a return standpoint. And speaking to the cyclical nature and where the S&P 500 has been, I thought this was a great chart. So this, to explain it, this gray box, you see the S&P 500 going across the page. That's the annual return on the index going all the way back to 2001. And you can see in the early part of the 2000s, the S&P wasn't the best place to be invested in, especially relative to these colored boxes or other asset classes. But the color to key in on are the blue and the purple. The blue is emerging markets, the purple is developed markets. And you look over time, this really speaks to that cyclical nature that I was referring to before when we're looking at valuations. From 2001 to 2007, having that international allocation relative to the S&P 500 was very additive to returns. Fast forward into the financial crisis, and then the last 10 years or so, the S&P has been the place to be from an investment standpoint. Well, we're starting to see signs of that changing. In 2016, emerging markets basically kept pace with the S&P 500 while developed underperformed. Well, in 2017, both outperformed for the first time since 2012. The main question we see is 2017 a false positive like 2012? We don't think that's the case because the economic environment today is much better. If we look, think back to that previous chart, much better today seeing every major economy in a growth phase versus a number of economies in a contraction phase, which is what you saw back in 2012. So again, we think this is the start. We think last year really is where these international markets have turned, and we want to make sure that we're exposed to them. One of the positions we've added to within the last 6 months gives us international equity exposure, but removes the currency fluctuation. It fully hedges the currency exposure back to the US dollar. So it effectively eliminates that currency fluctuation, which at times can actually detract from returns for an international investment. You can have years where the stocks have appreciated, but because the currency's moved against the dollar, it can actually detract from a total return standpoint. So we want to hedge away some of that risk. We don't think it's appropriate to have it 100% because currencies can be very volatile. And you can see over time, currencies can actually add returns. That's the purple shade that you see in this chart. But we do recognize that it does present some risks, and we wanted to hedge some of that away. So that's why we have one of the currency hedge funds in the portfolio. So now the really exciting portion of the portfolio, your bonds. Bonds is another area that you're going to hear a lot of news about. Is the 35-year bull market in bonds over? Is the bond bear starting to wake up? I would say the key takeaway, and we'll go through a lot of fancy charts, the key takeaway is to remember, first and foremost, fixed income, the role in the portfolio is to provide diversification relative to your stocks. If you look historically over time, you see what's called, I'm going to use a technical term, but negative correlation. Negative correlation, all that means is when stocks are up, bonds are usually flat, you get a yield return, nothing more. When stocks are down, your bonds are usually flat, maybe slightly negative, maybe slightly positive. You think back to 2008, what was one of the only positive performing asset classes? It was fixed income. So as a bond investor, as a diversified portfolio investor, you've got to remember that fixed income is really there as a diversifier to your equities. But when we think about where we are from a yield standpoint, as Steve alluded to, the 10-year's been trading at about 2.8%. We hit a low of about 1.33% back in 2016. A lot of prognosticators have been calling that the end of the bull market. Rates have been fairly range-bound if you think back over the last year. Basically, the 10-year ended up where it began. It traded in a range of about 60 basis points, or 0.6%. It's the tightest spread since the financial crisis. So you're seeing long-term rates trade very tight, and you're starting to see short-term rates go up because the Federal Reserve has been steadily increasing short-term rates since December 2015. All that really means is now you're starting to see that yield curve flatten, to Marty's slide before. We don't see it as an issue, but it's something that we're tracking because once that inversion happens, that's a pretty telling indicator from a recessionary standpoint, and that might be the time to really reduce risk. So it's one of the things that we're looking at, those converging short-term and long-term yields. The reason why we're defensive within our fixed income positioning is because of this chart. And this chart shows you the duration. And duration, what that means is it's a measure of interest rate sensitivity. For every 1% rise or fall in interest rates, your portfolio or your portfolio of bonds moves by your duration. So if I have a duration of 6 years, which is where the total bond market index is at right now, if rates go up by 1%, the value of this index is going to fall by 6%. It's going to fall by your duration. So duration is very important. It's one of the things that we're constantly monitoring. And it's one of the reasons why within our fixed income, we are very defensive. We are shorter than the index, and that's by design. It may act as a headwind when interest rates go down. We don't think interest rates are going down, at least not from these levels. We don't think they're going to skyrocket, but we do see interest rates slowly and steadily increasing over time. So we want to make sure we have less interest rate sensitivity within our portfolio. And that's what we've done. If you notice your positions, on average, our duration is running at about 3.5 to 4 years versus 6 years. And that's by design. We want to be defensive because our overall allocation is overweight stocks because we do think that the probability of recession is low and equity markets can run. So if our fixed income is there to really diversify and protect against equities, well, we want to protect against rising interest rates as well. This just speaks to the last 6 years looking at the S&P 500 or US equities versus that broader bond market. And the S&P has outperformed for 6 years in a row, an average return of about 16% versus a 2.5% for bonds. So we get the question a lot, why do I have fixed income in the portfolio? Why wouldn't I just invest in stocks? If you're a long-term investor, that's a great argument to make. However, when we look, and this is through the full drawdown, and I talked a little bit about 2008, you've lost money in bonds, but you've lost a heck of a lot less in fixed income than you have in the equity markets. And it's just something to keep in the back of your mind. You may look at the bond funds in your portfolio and say, why do I have these in here? It's really to help soften these drawdowns when we see these volatile periods, which may start to become the norm. Last year was abnormal in terms of the level of volatility. We may see these fits and starts more and more, especially as central banks, keying in on the Federal Reserve, they're stepping away from adding liquidity into the system. The Bank of Japan, the European banks, they're still putting liquidity into their economies, but over the next year or so, that may start to recede. So we may see more of these significant ups and downs in the market. So that's why we want to have some fixed income in the portfolio. So overall, just to summarize, we've reduced our sensitivity to interest rates. We're underweight bonds relative to stocks because we do think we're still in this equity growth phase. We've increased our exposure to active management. They can manage the duration for us. We key in on managers that tend to be more short-term in nature, but they're much more nimble. The bond market is 3 times the size of the stock market, so we want to use an active manager that can control credit risk, control duration relative to that broader bond market. And with some of the changes we've been making, we've been adding in some international bonds as well through these active managers.